Today on TapHere, we are joined by a very special guest. He is Noah Solomon. He is the Chief Investment Officer, the CIO of Outcome Metric Asset Management. So what it sounds like is you're applying what you have, what you know works, and then you're exploring different markets as opposed to, I'm going to go see what's happening in X market and then come up with a new model per se. Is that fair? Or is it a little bit of both?
It's a bit of both.
Okay.
So for example, I would say from 10,000 feet, what we've done in Canada is the same as what we're doing in international.
Okay.
From 10,000 feet. But the individual parameters have to be tweaked a little because they're not the same. They behave differently. They have different patterns. They have different behaviors. But I would say the overall philosophy is the same, just with tweaks.
Okay. And then looking at sort of how things might have or might not have changed, but data inputs, different tools, resources. I kind of asked this before, but what is there new or is there different approaches that allow you to feel a little bit more comfortable in exploring those?
Well, we're always, the way I like to think about myself as a mechanic, and I'm always, on the dolly or whatever you call it, on my back underneath the car, fiddling around, But in this case, you're experimenting with a model, seeing to figure it, just like they can make the engine faster or more fuel efficient or whatever. They're tweaking, I'm tweaking with the model to see if I can eke out, get a little more return or lower the volatility a bit. I haven't been tremendously successful. We haven't done much since we launched in terms of tweaks, which is either, arguably a bad thing, but maybe a good thing because it means you really put a lot of work into it at the beginning. So there's not much left to improve, depending on how you look at it. Frustrating, but in the way these kind of strategies are developed is you test them going back 20 or 30 years or what have you, and you see, had I followed these rules, how would I have done? Or it's called a simulation. Mm-hmm. So in quantitative investment world, the expression is it doesn't cost anything to practice.
Right.
However, there is a danger to that. And the danger is too many people who are good with data and programming don't really understand finance or statistics. And what I mean by that is you let the AI drive you instead of driving the AI. So, this may bring back bad memories for anyone who took an introductory economics class, but there was an economist, he may have won the Nobel Prize, named Ronald Coase, C-O-A-S-E, who developed something called the Coase theorem. But this isn't about the Coase theorem. He had a great expression that I love. And he said, I'm pretty sure if I torture the data for long enough, it will confess. So the danger in AI's advantage can also be its pitfall.
Right.
Meaning it can look for patterns and patterns until it finds something. It will torture the data until it finds something good. Now, if you really don't understand the deeper statistics or the reason why it's looked good in hindsight, they always seem surprised when they go apply it in real time and what went wrong? It looked so good in hindsight. How come it doesn't work in the real world? Because they don't understand they've tortured the data. They don't know how to, whereas they're great programmers and they're great at manipulating data, they don't understand how to properly test against the pitfalls of overfitting or torturing the data. And then they wind up surprised why something that looked great in virtual world doesn't work in real world.
So I saw a clip recently, one of these reels or whatever, where basically someone put the phone with ChatGPT talking and the phone with ChatGPT listening. And they just started talking to each other. And they think the clip was something like called "This is Hell." The point of it is, and my question for you is, thinking about how much machines actually will continue, and I realize it's hypothetical, but how much do you feel like they'll actually contribute and bring in more of the data and actually just kind of fully take over versus working with the data that you want them to? Like, in other words, from the future perspective, do you see that happening?
No, I wouldn't say the machines are going to take over. So everything happens at the margin. And, I don't believe that, active management will disappear. There won't be one active manager. They'll go the way of the dinosaur. I don't believe in that. But I do believe at the margin, you are seeing and will see more of a shift towards two things. And it's rational. Number one is more data-based investing. And number two is passive investing, that shift has been around for a long time. And it's funny how long some of these things can take. The expression is, if a tree falls in the forest but nobody hears, then it doesn't really matter. Paul Samuelson was the first American to win the Nobel Prize in economics. Probably wrote your introductory economics textbook. And in the 60s, he had this thesis, which was, it was basically an index fund, but he didn't call it that. He said, well, it's a well-diversified, long-term buy and hold portfolio, low turnover. He was basically, in many ways, describing an index fund, but he never launched an index fund. He was an academic. He didn't want to start a fund company. And then a few years later, or almost a decade later, Jack Bogle was one of the first, Vanguard, did it. And just to put things in perspective, he knew then, or he suspected, that an index would outperform the vast majority of active managers. And he launched one of, if not the first, index fund. The S&P, they didn't call it the S&P 500 fund, but it was but that's what it was.
Okay.
And at the time, the things people said, they said it was un-American, they called him crazy, they took out ads, they called him every name under the sun. Well, he passed away a few years ago, but he did have the last laugh because he was right, but no one knew it. Today, the data, as I said, is very damning. People know it. Even Buffett knows it. What did he say? When he passes away, something like 90-something% of his assets are to be invested in the S&P 500 index.
Right. After a career, right? Obviously, and
Now he does certain things that only he can do, and there's certainly he amasses cash and he's not fully invested in it. He is, but putting that aside, he's trying to tell you something.
Yeah, interesting.
One other thing I should mention is, what we do is scalable.
Okay.
But for example, the problem in Canada also is if you're a $20 billion fund, Canadian equity fund, you have no choice but to basically be, the pejorative term is a closet indexer. Meaning your portfolio is going to look very much like the index. You have no choice because the index is market cap weighted. The biggest names, the largest companies that trade the most, have the highest weights. In Canada, it's too small. If you're $20 billion, you have no choice because nothing else can absorb that much capital. You have to be semi-cap weighted. Which brings me to another point. So, when we were first coming, in addition to looking at the SPIV report and saying there's an opportunity, we did something else. We looked at the 10 largest dividend-focused Canadian equity funds at the time, and we looked at their top 10 holdings. And then we compared those top 10 holdings to the top 10 weights in the TSX index. And they were almost identical. What does that mean? It means they're saying they're active, they're charging an active fee, but in reality, they're just hugging the index. Now, here's the simple algebra. Imagine a scenario where you're an active manager and you basically hold the index. You own every stock in the TSX and their exact same weights as their weight in the TSX. And then you charge a fee. This is simple algebra. You know what your returns will be? The index less your fee. 100% guaranteed underperformance.
Again, why do people do it then?
As I said, necessity is the mother of invention.
Yeah.
Especially here, it's changing, but you got paid to show up.
So looking forward, 5 or 10 years, do you see more people kind of, and I don't want to believe me, this is not meant as an insult, it's more just fact, drinking the Kool-Aid, drinking the data analysis, the actual computational approach?
Yes and no, to the extent that those using a computational approach have been able to demonstrate that they can add value, then people are rational. They will go. If they can't, then they won't.
Okay.
You know, and I think there will be some people that use it that can and some people that use it that can't. You can never get away from the person. There's the machine, and it doesn't have emotion, and it doesn't have fear, and it doesn't have greed. But at the end of the day, someone made the machine.
Right.
That machine is reflective somewhat of the philosophy and the conception of its maker. You can never truly get away from a human. You can get away from emotions,
Sure.
but you can't totally get. Even with quant strategies, you're still betting on a person in a way, in a roundabout way.
Someone needs to be able to hit the emergency
Someone had to
switch.
design it.
Yeah, and design it, of course. Yeah, fair.
If you have no faith in someone that built the machine, then don't use the machine.
One thing everybody is certainly focused on these days is crypto, stablecoins, blockchain, all of the technology, the idea that assets can and maybe even should be digitized. Does that, if at all, play into how your models work, how you work, how you view the world, the investment world?
Not particularly. And I'm not particularly familiar with blockchain or stablecoin or Bitcoin. So I'll talk about the little I know, which I think is useful. And then I'm going to stay away from the 99% I don't know. So the first thing I would say is you have to separate the blockchain technology from Bitcoin. One underlies the other, but they are separate and distinct things. Blockchain is a technology. It can be applied to consumer data, consumer spending patterns, customer loyalty program. It can be applied in a billion different ways. One of those ways is Bitcoin. So I want to separate those two things. Blockchain, I think, will be very transformative across many industries. Because at the end of the day, what blockchain is better, cheaper, faster.
Right.
That's productivity.
And more accurate, presumably.
That's productivity.
Yeah.
At the end of the day, all those things combined go into one word: productivity. Better, cheaper, faster. So I think blockchain will revolutionize the way we do a lot of things and transact in a lot of things. Moving to Bitcoin, they really still have to come up with a use that I can see for it. You know, they're saying it can do this and it can do that, or it will become this. As of right today, its primary purpose that are two things: speculation. You can buy it and hopefully it goes up, or short it and it goes down. So speculation. And number two, money laundering.
Right.
Maybe that will change. However, when I look at an asset, and this transcends Bitcoin, frankly, I don't let people tell me what it is. I let it tell me what it is. And what I mean by that is, I'll use gold as an example. There are some people that will say, well, gold is a hedge against inflation. It does well when inflation is accelerating, or it goes up in times of panic, or it goes up when the US dollar goes down, so it's a good hedge against the US dollar. And I say, I don't want to hear any of it. Again, let the data speak. So what you would do is you would regress or statistically analyze the relationship historically between gold and inflation, or gold and the dollar, or gold and what have you. Let it tell you what it is. Don't let others tell you what it is. So the analogy is in Bitcoin today. People will tell you it's a whole bunch of things. It's the second coming of whatever, or it's the new currency, or it can be used to fly to whatever. I don't know. But I will tell you this that I've observed. One thing it is it's a risk asset. And
meaning,
you tend to see that when stocks are doing well and you're in a risk-on environment, it tends to do quite well. And when people are not feeling good about the world and fear is ruling the roost instead of greed, and stocks are going down, other risk assets are going down, Bitcoin tends to go down. So one thing I would say are those that think it's a good diversifier are wrong.
Okay. Fair enough. And I'm sure, and people would look at gold and say, yeah, I mean, that's still what you go into.
Gold I accept, but
Yeah.
Bitcoin is what they call a Texas hedge.
Right.
You know what a Texas hedge is?
You're going to tell me.
It was used with cattle ranchers who own cattle and then would buy cattle futures, meaning you're exposed both ways.
Huh. Okay.
If cattle prices go up, you win on the cattle you own and you win on the exposure you have. It means a Texas hedge means it's the opposite of a true hedge. It's not reducing your risk, it's doubling down. I think if you're looking at Bitcoin to hedge your stock exposure, you have a Texas hedge.
Fair. This has been great. I mean, thank you. And I kind of think I know the answer to this because I think what you're going to say is the machines and the models and the algorithms tell me what should come next. But the question, of course, is looking at AI, looking at technology, looking at how it's all sort of impacting stock prices, the markets in general. Are we in a bubble?
So the short answer is, I don't know. Bubbles only are known in hindsight once they become a matter of record. Maybe it will prove to be one, maybe it won't. But if history is a guide, and again, this is back to emotion and human behavior, we do the same thing over and over again. The players may change, the assets may change, but how we're wired doesn't change. No one wants to miss a hell of a party, and they don't want to miss 1 minute of it. So AI, I do believe. I don't believe it's a farce. I believe it will be truly transformative. But that does not mean you can't have a bubble. So, railroads were truly transformative. They weren't a scam, they weren't a hoax, they were a real thing. They really did change the way the world works. However, you had a huge bubble and bust. They got overinvested in, overinflated, and a lot of people lost a lot of money. Never underestimate the ability of human emotions to get ahead of even the best ideas. So this is not about whether AI is real or not, or won't have a tremendous impact on the way we do things. It will. That doesn't mean you can't have a bubble. So a lot of people say, well, this is like 1999. It is and it isn't. So in 1999, you obviously had a bunch of companies that never made a dime, and arguably in hindsight never had a hope of making a dime, that had huge market values ascribed to them by the market. And we know how that ended, and they went to zero, and they're not with us today. But you also had some very good companies then that went on to be even greater companies, such as Amazon, such as Microsoft. These are part of the Magnificent Seven. Tesla was not around then. But those companies, neither was Google. But those companies, not as a public company, but those companies were. By the way, Amazon went down 80%. Microsoft went in the bust.
Sure,
the tech
2000,
bust.
yeah.
Microsoft went down 40. Point is, these were good companies. They were good companies and then they were good companies now. Even better. And had you held on, you would have made a hell of a lot of money. But who can really hang on to an 80% drop? I don't know many people that have that fortitude. So again, never underestimate, for even real companies, the ability or the bias of humans to get ahead of even the best. And there's a Buffett quote where, I think the analogy is you're at the ball. It's Cinderella and your ball. And everyone knows that at some point it's going to turn into pumpkins and mice. That having been said, nobody wants to miss even 1 minute is what is a hell of a party. But there's a problem. The clock has no hands.
Right.
The question is always when.
Right.
I answered at the beginning, I don't know whether we're in a bubble, but I do suspect that things might be running a little bit ahead of themselves. But the question is always when. If you said, you know what, I'm just talking about stocks in general, it could be applied to AI stocks. Let's say a group of AI stocks, and you say, you know what, I'm getting out of them all now. I think this is a bubble, and I get out. Then they go up 50%. And then they go down 50%. You haven't added in any value. You had an opportunity cost of 50%, and then you didn't suffer the loss of 50%. So you broke even on the round trip. The question is always when. This party could go on for another couple of years. I don't know. So people say you can't time the market. I agree. You cannot perfectly time the market. Nobody I know can consistently pick tops and bottoms, exact tops and bottoms. But you're asking the wrong question. You're basically saying because you can't be perfect, you shouldn't do it at all, which is sort of a straw man argument. The question is, can you be close enough or accurate enough to add value on the round trip?
And I got to ask, what, if anything, have the models, the data, any analysis you may or may not have done with respect, again, to this kind of bubbly world that everyone's talking about? What does that say?
Well, first of all, we can't buy those stocks because they don't pay dividends. That's a different asset class. So they're not in my, I can't make.
So you're not even running like a sidebar
no,
or sort of, okay.
No,
fair.
I can't do that. But, back to timing, whether it's a group of stocks or whether it's the market as a whole, the most powerful force in markets in the post-war era, and I don't care whether you're talking about stocks in Denmark or bonds in Canada or real estate in the United States, it doesn't matter. Any asset class in any geography, the most powerful force is reversion to time trend. So if your long-term trend is 7% a year, and you've been doing 15 for several years, you've had excess returns above and beyond the average, you're due. Timing it exactly is impossible. That doesn't apply to broad asset classes like stocks. It's sectors, hot sectors. Today's winners become tomorrow's losers. Yesterday's dogs become tomorrow's darlings. That goes across geographies, sectors, stocks. Now you can't time it. So there's nothing I know of that can help you in the short term. If you're going to ask me what I think a given stock or a market will do over the next month, quarter, year, 2 years, I'll give you a coin and you can call heads or tails. Like, I'm happy to profess ignorance when I really think it's a mug's game.
Fair.
However, you can say something intelligent over longer time periods, say 5 years, 7 years. And those are valuations. So if you're saying, well, I'm light on stocks now because I think valuations are high for the, it doesn't matter for the several years. But as it turns out, they do matter for average annual returns over the next 5 years. In other words, valuations are a useful mechanism for short-term timing, but they are very predictive of average returns over the medium to long term. Meaning, if you look at periods when valuations have been well above average, the average annualized returns over the next 5 to 7 years have been well below average, and vice versa. So I call it a coffee can trade, meaning you have an empty coffee can, you put something in it, and you bury it in the backyard and don't look at it for 5 years. That's the only option you have, because I don't think anything can be done over the short term to give you any edge. The time capsule trade. But given where U.S. valuations are now, both in and of themselves relative to their own history and relative to other markets, and given how that pattern plays out consistently over history, maybe this time is different, I don't know. But given historical patterns, it is highly likely that returns for U.S. stocks over the next 5 to 7 years will be below average. And in relative terms, it is highly likely that other developed markets, be it Canada, Europe, or Japan, will outperform U.S. stocks over the next 5 years. Now, again, I am not making a comment on the recognition path, how it gets there. Maybe for the next year, U.S. stocks continue to outperform, or 2. But over the next 5 years, I think that is a very good bet based on relative valuations and how that's affected historical patterns.
Quick lightning round. Yeah?
Sure.
Question 1. The biggest investing myth that you wish would disappear?
Can I pick 2?
No.
Oh.
Yes.
Okay.
Yes.
Okay. Well, the first one is right now, private investments have become viewed as some panacea that they're the be-all, end-all and the ultimate panacea they're the best thing in the world. And I think they may have value, but the fact that they're being embraced as this foolproof panacea will end badly.
Okay. What was the other one?
The other one is this common study you see, which is if you miss the 10 best days in the market every year, your returns will be horrible. I hate that study, and therefore you should never change your mix or your portfolio. Isn't the right comparison? What happens if you miss the 10 best days and the worst 10 days? That is a biased study that is designed in favor of the industry.
Okay.
Drives me nuts. It is so self-serving.
Next question. If you could only look at one data signal for the rest of your career, what would it be?
Two. Again, the two most powerful forces in markets are momentum and value.
Question number 3. What is the most overrated hot take going on in markets right now?
Privates.
Privates. Okay.
It's not that I don't believe in them. It's the expectations relative to the reality. They may very well be valuable and good, but they're viewed as a panacea, and that's never good. People will be overallocated.
Question 4. Which piece of advice would you really or truly want every Canadian investor to follow?
Beware of shiny new toys.
You just covered like half of what the market's basically looking at right now, but okay.
Well, it always takes it always takes a different form. Usually the pattern of financial services industry is often things start as a good idea. Sometimes they start bad, but let's give them the benefit of the doubt. And then over time they get perverted and Frankensteinized into something bad. Mortgage-backed securities are a good idea. They were a good idea then, they're a good idea now. And they were. But then they get perverted into CDOs and CDO squares and tranches, and it ends badly. Index funds, ETFs, simple index tracking ETFs were a good idea then, they're a good idea now. But then now you have triple inverse levered ETFs with exposure to underwater basket weaving industry in Indonesia, gets perverted in Frankenstein. You know, one of my favorites is the covered call ETFs.
Oh.
So they're very popular. They're sold, they get you extra income and it's all good because of this. You know, if you look, in many cases, you have the plain vanilla ETF and then you have the covered call version. If you look at any of them over any reasonable period of time, the vanilla version way outperforms the fancy one with the bells and whistles. Beware of shiny new toys, because in most cases, I can describe them as follows. They're taking a dime out of one of your pockets, putting a nickel back in the other, and then saying how good they are.
Okay. Good analogy. I love it. In one word, the future of wealth management. And you have 3 choices here.
Hybrid.
Okay. And the choices, by the way, were AI-driven, hybrid, and human.
Hybrid. And when it comes to actual investing, picking stocks, I think it will become much more at the margin, much more automated or data-driven. But the advice aspect of it, there will always be a human element involved in that. It will never go away.
See, and I came here today expecting you, in some degree, to say, yeah, the human element's going away. It's just a matter of time.
I think it will be diminished, but I don't think it will never go away.
I think a lot of people will be very happy to hear that.
It will never. And I'm not talking about picking stocks or bonds. I'm talking about wealth advice, how you should be allocated given your needs, wants, and fears, and your retirement plans and all that. That will never go away. When you're talking about those kind of long-term life decisions, you want to deal with a human, regardless of whether it can do it better or worse than a machine.
Cool. Last question. What is the weirdest or most surprising data that you've come across as part of what you're putting together in terms of an investment approach?
Well, I've already told you what it is.
Privates.
No. It's the fact that an algorithm that knows nothing about the company per se, other than what sector it's in and what its stock price is or dividend yield, can go up against a large team of seasoned analysts who specialize in their particular sector and they speak to management and they're poring over the company reports, can beat that group. One algorithm can beat not just a human, but seasoned, experienced professionals. Now, I shouldn't be surprised because this is what I do for a living, but when you think about it that way, it's almost strange. It is and it isn't. But when you think about it, because it doesn't know management, it doesn't know what the company's latest products are or do channel checks, or it's asking the hard questions on the earnings call when the company reports, but it can beat almost all of them.
Noah Solomon, Outcome, really appreciate your time. Thank you for having us, and thank you for talking about, investing man versus machine mostly, but thank you.
Thank you for having me.
And now for the legalese. The information provided in this podcast is for educational and informational purposes only and does not constitute financial investment or legal advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Past performance is not indicative of future results, and all investments carry risk. The views expressed are those of the hosts and the guests and do not necessarily reflect those of any affiliated organizations.